I'm Michael Fox, and this is the Prospector News Podcast. And I have joining me the president and founder of the CPM Group, Jeffrey Christian. Welcome back to the show, Jeffrey.
Thank you for having me back, Michael.
It's always a pleasure to have you. I enjoy these conversations, and I hope our listeners do as well. So last week, you guys launched your annual look at the PGM markets and the PGM Yearbook. And you had a very lengthy conference call where people got to hear your positions on everything, and you answered some questions. So today I thought I'd like to get you one-on-one, and we could have some conversations about the PGM markets.
Yeah, sure. What did we miss?
Oh, we didn't miss anything, but I like to have these these conversations and break them down a little bit more than. It's more of a casual conversation than a formal presentation. So
I prefer the conversations myself.
So when I look at the PGM markets, I kind of look at it as it's like the silver market, but vastly different in that the platinum, I guess, not so much the palladium, the rhodium, but the platinum itself has some value as a precious metal. But the vast majority of the market itself is actually industrial. Is that a quite the way to look at it?
Yeah, that's the way we look at it. Gold and silver primarily trade and behave price-wise like financial assets. If you say, what trades like gold and silver, you see the US dollar, the Japanese yen, currencies, US treasuries. Platinum, palladium, these are industrial commodities primarily. They have some investment and financial aspect to them, and you will find investors buying into them and holding them, but they are much more driven by their industrial uses and their actual newly refined metal supplies coming in from mines and from secondary recovery.
So let's take a look at the demand for PGMs. So essentially, PGMs are driven by transportation demands. They're the key components in the catalytic converters we find in the engines of practically everything.
Yeah, the Clean Air Act in the United States started it, and you started seeing catalytic converters being used on automobiles and trucks in model year 1974. Which were built in 1973, and when we look at the PGM markets, platinum, palladium, rhodium specifically, what CPM Group has been saying, and the title in our long-term platinum group metals 10-year, well, actually we take them out to 25 years to 2050. The title has been "The Tide Has Turned," because the last 50 years of platinum group metals markets have been characterized by the introduction and growth and dominance of automotive catalytic converters as the largest use for platinum, palladium, and rhodium. But we've kind of changed. The demographics of the auto market are changing. You have electric and hybrid vehicles coming into existence, and there's also some demographics where people are maybe buying fewer vehicles in the industrialized world in Europe, Japan, and the United States. And as a result, the tide turned. And the next 50 years are probably going to be characterized by a slow reduction in the amount of PGMs being used in auto catalysts, in contrast to the last 50 years.
And why is that? Is that we're simply going to have less vehicles, or is this going to be the move to electrification that's going to cause this?
It's a combination of factors. As I said, there's some demographic changes, and you're seeing, mature markets for automotive demand in Europe, Japan, the United States. You still have strong growth and projected strong growth for automobiles in China, India, and other parts of the emerging markets and developing countries. There are people who we think they focus on Europe and North America. There are people in the automotive industry who talk about how we've probably passed peak auto. market where the demand, the production and purchases of automobiles peaked around 2017, 2019, and will never be that high again. CPM Group has some growth because we, I think, probably put more emphasis on those emerging markets and developing countries, still buying more vehicles. But you're seeing demographic changes where people are saying, I can use ride shares, I can use car sharing services. There's different ways of doing this. There's improved mass transit in Europe and in Japan and in other countries. So you're seeing the demographics of demand for automobiles change and sort of peak in the industrialized worlds. But then you have the rise of electric vehicles, and electric vehicles are now taking about 13% of the light duty vehicles, not the big trucks and buses, but smaller passenger cars, SUVs and pickup trucks, and smaller last mile delivery trucks. About 13% of that market now is electric vehicles, and they don't use engines and they don't use platinum group metals to clean up the exhaust because they're not burning gasoline or diesel. They're not burning hydrocarbons. So you've lost 13% of the light duty vehicle market for auto catalysts, and that has been reflected in lower demand for platinum, palladium, and rhodium in the auto industry, which is, again, by far the major use of all three metals.
Yeah, the electric vehicle market, though, seems to, at least in North America and in Europe, has apparently kind of stalled in its growth into some degree. Is that stalling being reflected in your demand matrices?
Yes, we're not electric vehicle skeptics, as you probably know. I wrote a book on electric vehicles in the 1970s. We're not electric vehicle skeptics. We're electric vehicle realists, and there's been over enthusiasm and too high of expectations about electric vehicles, and people haven't paid attention to numerous headwinds: commercial, industrial, financial, and demographic headwinds to how fast you can develop an electric vehicle market. In addition to that, there are some consumer hesitations which have come to the fore, and we've talked about this for years. One of them is that with electric vehicles, you're not necessarily reducing carbon dioxide emissions. You're moving them from the tailpipe of the vehicles to wherever you're making the electricity. Because right now, the major sources of power for electricity to power electric vehicles and other things are coal and heat, coal and natural gas. And there is still some petroleum-based power plants too. So right now, the shift to electric vehicles isn't necessarily reducing carbon dioxide emissions. In some cases, it's even increasing it because of the carbon dioxide emitted in the mining and production of lithium-ion batteries, lithium mining and lithium-ion batteries. So there are people who have been buying cars, in China, which is the major EV market. People have been buying electric vehicles because the government says buy electric vehicles. But in Europe and in North America and in Japan, to some extent, people have been buying electric vehicles because they want to try to help combat climate change. And when they realize that the electric vehicles don't necessarily combat climate change, they say, gee, I've been sold a bill of goods. So not only do they stop buying electric vehicles, but they're kind of angry at the auto industry and the governments for misrepresenting what they were buying and what it would do for the climate change. In addition to that, the battery packs last, 5 years maybe, and then they have to get replaced. There are government subsidies in the United States and in other countries for purchasing a new electric vehicle, but like 3 years, 5 years out, you need a new battery pack. It costs thousands of dollars to buy one, like $8,000 to $10,000. You have a 3-year-old or a 5-year-old vehicle, and you're supposed to pony up another $10,000 to keep it going. So 80% of the Americans who have bought electric vehicles say the next vehicle they buy will be a conventionally gasoline-powered vehicle. So you have that kind of consumer constraint. And then there are some other constraints too. So what you're seeing is a slowdown in the enthusiasm in the industrialized world, ex-China, for electric vehicles. But it's still continuing and it's still taking market share. And you're seeing a shift into hybrids, which actually use more PGMs.
Yeah, it's really interesting. I had a guest over for a barbecue last weekend, and they have an electric vehicle. And as our listeners know, I live on Prince Edward Island in Canada. It's it's the smallest province in Canada. You can go tip to tip on the island in under 3 hours, and that's reality. When we were talking about their electric vehicle, it was like, yeah, as long as I stay on the island, it's a great source of transportation for them, for my guests. They were able to move around quite readily, handily. It wasn't a big issue. But the moment that they wanted to go someplace else, that's when it became a problem, because there was all sorts of other factors that entered into the equation. Where do we recharge the vehicle? How long do we have to stay there in order to get the vehicle recharged? Can we get from A to B on a long distance with charging stations so that we know that we're not going to run out of juice on the way? And for someone like myself, I've got a hybrid, but it was factors that we take for granted. There's gas stations everywhere. We can fill up the car quite readily. Takes less than 5 minutes to fill the car up, and we don't have to actually hyper plan our trip in the same method that they do. So I can understand where some of this pushback is coming from.
Yeah. Yeah, it's something that you should have expected. And most people in the auto industry and the electric vehicle industry did expect that. But, the politicians and the marketing people probably did not emphasize that as much as they should have in telling people about why they should be using electric vehicles. Yeah.
So when I look at the transportation, to me, in my mind, there are, well, I was going to say three, but I guess ultimately there's four types of engines. There's the diesel powered engine, which is quite popular in Europe. There's the regular gasoline powered engine, which is quite popular here in North America. There's the hybrid, which is a combination of electric and gasoline, either diesel or otherwise. And then I guess, the fourth is the electric vehicle. The PGMs that go into each of these types of vehicles, like you mentioned earlier, that more PGMs need to go into the hybrid. So what is the makeup of the PGMs in each of these types of vehicles?
Until recently, well, diesel vehicles tend to be more platinum intense catalytic converters. They use some palladium, and you can substitute some of the platinum in them with palladium, and then they use rhodium. Because palladium prices have been much higher than platinum prices for several years, you've seen diesel vehicles be more platinum and rhodium. Gasoline-powered vehicles, you can use more palladium, which is why the auto industry started shifting to more palladium-intense catalysts in the 90s. And that has been the factor that has driven palladium prices to a high premium until recently against platinum. But they tend to, what we're seeing now over the last couple of years is a shift back away from palladium intense catalysts and gasoline vehicles to more platinum intense. And of course, when you do that, and what's happened then is that the price of platinum is now at about a $60 premium to the palladium price, because the auto industry is using more platinum again in the light duty vehicles. that are gasoline powered. And that's the major segment of the market. Electric vehicles obviously do not use any PGMs. Hybrid vehicles, because they start and they stop the engine. And if you look at the emission of noxious and harmful gases from an internal combustion engine burning a hydrocarbon, the biggest hit of bad exhaust comes when you start the engine. The cold start is where you find that you have more of the bad hydrocarbons, carbon monoxide, nitric oxide, nitrous oxide coming out. So you need a higher density of PGMs for the cold start. With a hybrid vehicle, you're starting and stopping. You don't get to the point where you're running that engine at full steam on an ongoing basis unless you're on the highway. So you need more PGMs and hybrids. So that's there, and as I said, we take our projections out to 2050, and our view is that by 2050, you will still be seeing petroleum as the major source of energy for humankind, and you will still see probably half of the vehicles on the road, light-duty vehicles, using petroleum products, either diesel or gasoline, for their energy. Light-duty vehicles will still be gasoline. Heavy-duty vehicles like intercity buses, intercity trucks, long-haul trucks, they'll still be using diesel because diesel just has a greater power density compared to electric vehicles or hybrid vehicles or anything else that we've been able to find so far.
Yeah, have had an interesting take on the vehicle market myself. We keep hearing from our governments that they want to have electric vehicles. All cars and trucks have to be electric vehicles by 2030. That's been bounced to 2035. I hear they're bouncing it to 2040. But in the interim, the reality where it hits the road is that we don't have the raw materials to make all the electric vehicles that the government wants us to have in the short term to meet those goals and those targets. And I foresee a day where government, instead of mandating electric vehicles, they will start to mandate hybrid vehicles, and given that it's less harmful for the environment and it's a proven technology. Now, when you're looking at your demand outputs, given that hybrids use more PGMs, are those being factored into your data and your plans looking up to 2050?
Yeah, our model, which is pretty complex, breaks down the auto markets by major countries and regions. And we look at, diesel, gasoline, electric vehicle, hybrid vehicles, and then what they call plug-in hybrid vehicles. And we have that all in there. And our expectation is that over the next quarter century, there'll be perhaps greater interest in hybrid vehicles. Right now, and recently in the last few years, hybrid vehicles have kind of lagged electric vehicles. But, as you said earlier, there's been some consumer pullback in their interest in electric vehicles, and that has benefited hybrid vehicles. And we think that that's probably going to be the case for the next 10 years or more. When we go out to 2050, we see hybrid vehicles taking maybe 10% of the market for light duty vehicles.
Okay. Now, as we've been discussing, as the transportation industry goes, so does the demand for PGMs. Auto sales have not been good for the last little while. They keep falling. They've been lagging to the point where, if you're looking at the inflation numbers and breaking things out, you're actually seeing disinflation occurring in new and used vehicles as demand for vehicles is drying up. Do you see that as a short-term or a long-term issue?
Well, there's a whole bunch of factors there. First off, there's a long-term demographic shift where people in industrialized countries in particular are saying, well, maybe I don't want to own a car, or maybe I don't need to buy a new car. When I first started following the auto industry in the 70s, the average new car was kept 7 or 8 years. Now it's probably 10 or 12 years average longevity. Maybe I don't need to buy these cars. There's greater amounts of car sharing and ride sharing. So there's a demographic shift, which is the long term. Then there are some short term cyclical types of things and special event driven things. So you saw the auto industry fall sharply in 2008, 2009 because of the Great Recession. Then it started to recover. It kind of peaked around 2017 into 2019. The COVID and the global lockdown economically really hit the auto industry hard, and you saw a sharp drop in the number of cars that bought. When we came out of that in 2021, the semiconductor industry had also been seriously damaged, and the global trade and supply chain and the domestic supply chains had all been really disrupted. So you had a semiconductor shortness, you had shortages of other components that went into regular vehicles, and that caused the auto industry to not be able to produce as many cars as people wanted in 2021, 2022. In that environment, people started buying used cars, and they stopped selling off their used cars. So that reduced the amount of platinum, palladium, and rhodium being recovered from catalysts that were taken off of deregistered cars. But that's the supply side. But you saw people buying used cars, and used car prices shot up higher and faster than virtually any other component of consumer price index. And that has been falling now for probably 2 years. So that's going there because the semiconductor industry has sort of corrected its problems. The supply chains have more or less been rebuilt, although it's still problematic. And the auto industry has recovered somewhat in most countries. But you have these long-term demographic changes. You have the long-term shift to electric vehicles, which is eating up market share, taking market share from petroleum-powered vehicles. And then you have these shorter-term cyclical factors. Obviously, if we go into a recession at some point, yet this year or next year, that could reduce the number of cars being produced and sold for a time on a cyclical basis, but then you'll see a recovery. So there are people who talk about peak auto thinking that we'll never build and sell as many cars as we did in 2017. CPM Group thinks that may be a little bit premature. We do have, I think, growth in the overall light-duty vehicle market that we're projecting going forward for the next 25 years at least. But the growth rate will be much slower than it has been over the last 50 to 100 years in terms of the growth rate in the number of vehicles being built and sold.
Yeah, so we've kind of hammered on the demand side of this equation quite extensively, and let's go to the other side of this, the supply of the PGMs. Now, PGMs themselves come predominantly from two countries, South Africa and Russia. Is that correct?
Yeah, the bulk of platinum group metals comes from South Africa and Russia. There is some produced in the United States, Canada, Zimbabwe, and a few other countries. But you're really talking about South African and Russian supply.
Now, given Russia's prosecution of a war against the Ukraine and the subsequent embargoes on their goods, has that been affecting the PGM market on a supply side?
Well, it's interesting because there haven't been any sanctions or trade restrictions put on platinum, palladium, rhodium exports from Russia. The Western governments know that the auto industries in their countries, South Korea, Europe, the United States, Japan, the auto industries are a very important component of total overall economic activity. and they cannot afford to disrupt it. It already was disrupted by COVID and the supply chain and semiconductor problems. They don't want that to happen again. So they have not restricted PGM imports from Russia. That said, other sanctions and trade restrictions on Russia, other parts of the Russian economy have caused problems for Russian production and exports. The sanctions put on banks, Russian banks, that the Russian exporters used have been a problem. Trading in U.S. dollars and euros has been interrupted by Russian sanctions against using those, as have other factors. And then there have been import restrictions on components and equipment and reagents that are used in the refining industry and for mining industry in Russia that are also have military applications. So they've had sanctions and restrictions put on them. All of that put together has made it more difficult to mine and refine PGMs and reduce the flow. In addition to that, there have been some changes in new refineries and smelters within Russia, which have caused temporary reductions in production. So overall, we've seen production sort of flat. In the case of platinum last year, I think you probably had about a 100,000 ounce decline in Russian production. So there have been some interruptions, although there's nothing overtly, the London Bullion Market Association or the London Platinum and Palladium Market Association has put restrictions on trading in Russian PGMs. But that's sort of an aside because a lot of the Russian PGMs are being bought by catalyst manufacturers and they don't go through the London market. They go directly from a Russian refinery to a catalyst manufacturer. So those kinds of commercial restrictions have not really had too much of a major effect on Russian supplies of PGMs. Now, that said, the US and other countries have just imposed increased restrictions on various parts of the Russian economy. And we're waiting to see if those restrictions now have a more significant negative effect on PGM exports.
Yeah, one of those new restrictions is the United States is banning all enriched uranium from leaving Russia effective 2027. Even though the PGMs wasn't part of the original sanctions, do you foresee a time where the West kind of goes, well, yeah, maybe we don't need these PGMs from Russia any longer, too?
No, I don't see that happening. And, the enriched uranium exports, that's sort of like, Russia has stopped exporting enriched uranium to the United States already. So for the US to say, well, we're not going to buy any, it's like, that's okay because we haven't been selling you any and we don't intend to sell you any. So that's unique to the uranium market. But no, I think that the PGMs are so critical to the auto industry, which is so critical to the overall economies in Europe, North America, and East Asia, that I do not envision trade restrictions being put in place on PGMs, short of a world war, which I think we probably will avoid anyway.
Okay, let's move geography and take a look at South Africa, who is the main supplier of PGMs. The headwinds that always seem to come out of South African supply is labor unrest. You're constantly hearing about strikes in the mines, strikes in the processors. Is that going to be an ongoing thing in South Africa, or have they kind of settled themselves out to a working relationship between management and worker there?
Well, I think the South African mining industry has a number of really severe problems, and labor unrest may not be the worst of it all. But they have had social and political pressures on it. So as they watched the profitability of their mining operations suffer, and they've said we need to rationalize our mining industry, and the government, local governments as well as the national government, have put a lot of pressure on the platinum mining industry to not cut back on labor. So you'll see a mining company saying we need to lay off 30,000 employees and rationalize our production. And the government say you can't do that. You can't lay off 30,000 people who are very well paid by South African standards. These are really high paying jobs, and a typical miner in a South African mine might support like 10 or 15 people in their extended families. So you can't do that. So they negotiate, and at the end, they don't lay off 3,000, 1/10 of the people. They reassign them to other jobs. So labor is an issue, but capital expenditures have been an issue. They have, because of the lower prices and lower profitability, as well as all of the risks with power, as well as labor and social and political issues. The South African platinum industry has been underinvested for many years, and you're seeing lower production. Really, it started after 2006, but you're seeing lower production of PGMs in South Africa, which is probably going to continue for several years and maybe even accelerate over the next few years. Due to a lack of capital expenditures, a rationalization of the mining industry, a refocusing on profitability as opposed to the number of ounces being produced. And, the South African PGM industry is very much aware of the shifts going on in their major markets, in the automotive market, and the reduction in demand for PGMs in the auto industry. So they're aware of the fact that theirs is a mature market. The markets for their products are mature.
So, on a bigger picture geopolitical scale, both Russia and South Africa are members of the so-called BRICS nations, which seem to be wanting to go their own way in a lot of different ways as far as trade goes. Do you see their membership in BRICS as being an impediment to trade with the West? Or is this going to be one of those deals where it's not going to be a bifurcated economy?
I don't see the existence of BRICS and the participation of Russia and South Africa in BRICS as being an impediment for trading PGMs with the West. As much as the auto industry and Western economies need the PGMs, South Africa and Russia need the revenue that they get from PGMs. I think Platinum Group metal exports are perhaps the largest source of foreign exchange earnings in South Africa, and they're very important in Russia as well. And Russia, Russia had problems before it invaded Ukraine, but since Ukraine, it's had a lot of its foreign exchange assets frozen. So it's living sort of month to month in terms of its current account inflows of currencies that it needs to pay for its imports. So Russia and South Africa can't afford to let politics or distaste for the West get in the way of very much needed foreign exchange earnings. So I don't see that being an issue.
The last question out of all this is there are people that claim that there is a deficit in the PGM market. I'm looking at the supply and demand. I'm looking at your data, and I suspect I know what the answer is. But is there a deficit in the PGM market?
We don't see a deficit in the PGM markets. Right now, this year, the supply demand balance in platinum is very close to balanced. It's like a 4,000 ounce surplus that we're projecting in the platinum yearbook, and that is within the margin of error. But we look at the surplus and deficit as the supply of newly refined metal coming into the market from mining and from scrap recovery, less fabrication demand. And that gives us surpluses. And it gives us surpluses in like 40 of the last 47 years. So there's no deficit in platinum in terms of supply, newly refined supply relative to fabrication demand. Some people will put in investment demand with fabrication demand to make the market look tighter for marketing purposes. And then they may inflate their estimates of investment demand to make it look even tighter. But if you use standard economics, where a surplus and a deficit is total supply less fabrication demand, there are no deficits in platinum, palladium, or rhodium. And there's a lot of platinum and palladium in above ground refined inventories spread around the world.
So the notion of a deficit is, a marketing ploy by people who want to sell platinum.
Exactly.
Wonderful. So if people want to get their hands on a copy of the PGM yearbook as well as the gold and the silver yearbook, how would they do so, Jeff?
You can go to cpmgroup.com, our website, and you can order, buy, and download the report. It's an ebook. It's a PDF. It costs $160 US, and you can buy it and download it and have it. Or you can send an email to info@cpmgroup.com and say, I'd like to buy this report, and we'll arrange to sell it to you.
Perfect. And if people want to follow your musings as the world progresses and across, gold, silver, other metals, and the platinum, palladium markets, how would they do so, Jeff?
Well, we have at our website a lot of free reads and videos. We do 2 videos a week that are free on on YouTube. And when we launched our Platinum Group Metals Yearbook for 2024 last week, we did an hour and a half online briefing, which is available on YouTube as well. So you can get a lot of free reads and free videos on our website. You can go to YouTube and you can see all of these videos that are there. And that gives you a pretty good idea of who we are, what we do, and what our track record has been.
Perfect. I want to thank you very much for joining me today, and I look forward to future discussions on these markets and geopolitics and the world as it turns, so to speak.
Well, thank you for giving me the platform to speak.
Wonderful. Thanks, Jeff. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.